rate cut yesterday.
Look, they said they may pause now.
The S&P 500 hit an all-time high yesterday. It's down marginally today. If the stock market went up 1% a day, every day, no matter what, we'd be in a bubble. So that's not what happens. We back and fill, perfectly natural. I think there were some interesting sectors that hit prior resistance levels technically and fell off. One would be the KRE, regional banks, down 2.5% today, double as bad as the XLF on the session. They just hit previous resistance yesterday. Same thing with industrials. Take a look at the XLI. Previous resistance, couldn't get through, backing off a little bit. It's okay. It's not catastrophic. Everyone should calm down. Happy Halloween.
You have painted a scenario, though, recently that was pretty good backdrop for stocks.
Still think it is.
You went through a whole, riff on all of these things that you see.
We made a new all-time high yesterday.
Yeah.
I just want to repeat that, like less than 24 hours ago.
Well, but here we are, back to the Erin narrative of, a while back. President tweeting, people disappointed in Powell and the Fed. Fed's called it wrong from the beginning. Wall Street Journal editorial board this morning. Y'all see that?
Yep.
On the slowdown.
They don't blame Powell. They blame trade.
I'm quoting it right now. You're exactly right. President Trump and some of the White House blame the Fed and Europe for the slump, but neither explanation holds up. Quote, the strong evidence is that trade policy is the main growth culprit. Okay, until trade remains unsettled, can we truly take the next leg, Erin, that I asked everybody about whether we had embarked on that leg this week and, a couple weeks ago?
Yeah, so one of the questions that we're getting a lot of is the worst over? Are we going to start to see an inflection point now in growth? And you've certainly seen some surprises to the upside over the last couple of months. I'd argue, though, that the weight of trade is going to continue to put downward pressure on growth. However, that notwithstanding, that doesn't mean that equities necessarily need to do poorly. I mean, we've already seen the last 9 months trade be a weight on, global growth and U.S. growth. At the same time, as just stated, Josh said, stocks are at a record high. So I think what you're going to see is more of this divergence where the strong consumer cyclicals, those that are really leveraging the strength of the U.S. economy, like the consumer cyclicals, like housing in the U.S., those are going to continue to do well. But the sectors like energy, energy earnings have been terrible. Materials and mining, those sectors that are more leveraged to the global cycle, I think are going to underperform.
Fortunately, they're tiny in relation to the S&P now.
Exactly.
I think the two of them combined are less than 25% of the S&P.
Yep.
So
much less than that.